Last week we covered income tax, and this week I want to finish that off by talking about the other income tax, which masquerades as something else: national insurance. Yes, national insurance is not really insurance at all, it's just another tax. But this one is at least about qualifying you for various benefits, not least the state pension. As ever though, there's some nuance to how it all works. So let's put 5 minutes on the clock down here. Say a quick thank you to my friends at 7 Investment Management for continuing to sponsor the show, and let's crack on. So, who pays national insurance and how much do they pay? This is where I'm going to need to scooch over a bit and bring in a graphic, so I'll do that now. Just like last week, there are various thresholds that you need to understand. We're going to deal with employees first, then self-employed people, and then finally employers. So, if we're talking about employees first, the first threshold is the lower earnings limit. And for the 2019-20 tax year, that limit is £512 per month. So if you earn less than this, you get no national insurance benefits at all. I'll get into what those benefits are a little bit later on. Above that, then, we have the primary threshold, which this year is £719 per month. Now, if you earn between the lower earnings limit and the primary threshold, you get the benefits of paying national insurance without actually paying national insurance. To put it another way, you pay national insurance at 0%. Not sure whether that's really helpful or not. So next, we have the upper earnings limit, which is £4,167 per month. That equates to about 50 grand a year in earnings. Between the primary threshold and the upper earnings limit, employees pay national insurance at 12%. And then finally, anything you earn above the upper earnings limit, you pay national insurance at 2%. So that's all fairly straightforward. Different thresholds, different rates at which you pay national insurance. So let's look at the self-employed position now. So the names of the thresholds have changed and the amounts are very slightly different here. And this time, because we're talking about self-employed folks, we're talking about annual profits from whatever your business is. So first we have the small profits threshold, which for the 19-20 tax year is 6,365. Next we have the lower profits limit, which is £8,632. If your profits are above the small profits threshold but below the lower profits limit, then you pay national insurance at a flat rate of £3 per week. On any profits above the lower profits limit, you pay national insurance at 9%, all the way up to the upper profits limit, which is around £50,000. Any profits you make above 50 grand a year, you pay national insurance at 2%. With me so far? Good. Let's look at employers now. Again, the names of the thresholds are different from those for employees and self-employed people, but the amounts are quite similar to those for employees. So you have the secondary threshold, which is exactly the same as a primary threshold for employees, which is £719 per month. Employers pay no national insurance on your earnings up to that amount. Above the secondary threshold, employers pay national insurance at 13.8%, which is quite steep really, but that's basically it. Quite simple. There are some subtle differences to this. If you've got employees that are under 21 and all sorts of stuff, there's something, would you believe, called the upper secondary threshold, but I've largely ignored that for the purposes of this, just to keep it simple. So what do you actually get for all of this? Well, the main story is the state pension, and you need 35 years of complete national insurance payment records in order to qualify for the full new state pension. Now, if you're an employee, some other benefits are also dependent on you having a national insurance record. Things like contribution-based job seekers allowance, contribution-based employment support allowance, maternity allowance, and even the bereavement support payment are all dependent on you having an up-to-date national insurance record. So it's important that you check your record and keep an eye on how you're doing. And you do this on the gov.uk website. It's quite easy to sign up for it. If you already have a government gateway account, you can do it instantly. These days there are ways that you can sign up for the gov.uk website quite quickly. It used to be that you had to have a government gateway account and you used to have to wait for a password to come through the post and all that sort of stuff. But now it's pretty quick. And once you're logged in to the gov.uk website, you can check your NI record and it will tell you for each year, as long as you've been working, whether that year is complete or not. And if it isn't, how much you can pay to make up that year and make it complete. Now, you might not be able to make up for years that were incomplete, 10, 20 years ago, but the more recent years that have been missed, you will be able to make up with a voluntary contribution. And the website will tell you how much that might need to be. So you need to take a view. I've done mine, and I can see that I only actually need 8 more years of complete national insurance record to get the state pension. Now, I've got about 23 years more work to get to the state pension age, so I'm probably going to work for 8 of those 23 more years. So I'm not too worried about making up some years where I didn't pay sufficient national insurance. But you need to take a view for yourself. Generally, it will be worth making up missed years. If you think otherwise, you work till state pension age and you're not going to get a full state pension, it probably will be worth you paying the extra to make up the gaps. Okay, next week we're going to look at how tax relief and salary sacrifice work to help you reduce your income tax and your national insurance bill while getting added benefits in the process. Thanks for watching. I'll see you next week.